Well, hey there, everyone. Dave Keller here with Market Misbehavior. Happy Thursday, May 14th. It is late here in Boston, but finally back to the hotel after dinner. Time to record a quick video for you. This will not be a full episode, but probably an abbreviated one just to hit on some of the key themes. But, again, I've talked to many people like myself who do daily videos. And when you skip a day for whatever reason, you always just lose a little bit of connection with the market. And earlier today at the CMT Spring Summit here in Boston, we were hosted at the Fidelity World Headquarters here in Boston, heard from a number of the portfolio managers, a number of my former colleagues who are technical analysts and technically oriented investors. It was awesome. Great discussion about the value of trend following, the value of momentum investing, the value of relative strength, the value of process and routine, the value of using technical analysis to generate ideas through scans and filters, but also to manage risk and getting you out of things that just aren't working anymore. And that was a consistent, those sort of general themes came up with in a number of the conversations. So it was an awesome sort of kickoff event. We'll be doing the event all day tomorrow. So not entirely certain when I'll be able to swing a mailbag episode. My goal is to do so, and please accept my apologies ahead of time if I just can't make it work, but I don't want to miss the opportunity to have some good time to reconnect with some of my good friends around the industry all in town here for this event. And I'm back home Saturday morning. By the way, I met a number of people who do watch the show at the event, which is always a lot of fun. So thanks to those of you that said hello, and I hope we have a chance to speak more tomorrow. Just a quick check-in on what's happening here. Obviously, a pretty good risk on day today. The S&P closed above 7,500 for the first time in history. We're doing a lot of those firsts here. The S&P closing up 0.8%. No real theme, I would say, between the three major indexes, all up about over 0.75%, less than 1%. So pretty similar. Certainly mid and small caps lagged a bit, and mid caps were the worst performers, although all were up. In terms of other key takeaways, and again, attempting to keep this brief and concise if I'm able to even do that. The VIX moving lower. We're now down in the low 17. So volatility continuing to tell you things are fine. The VIX and then the MOVE index, which is the volatility for bonds, both remaining pretty constructive here. Part of that risk on day for stocks. Bonds also drifted higher. Rates generally came down a bit. The long bond yield finished today just about 5%. 10-year yield around 446, we'll call it. Dollar index was up a bit. That move in the Dow, if there's anything that's not sort of feeling great, in today's session, I would say the rally in the dollar just sort of stands out to me. Commodities not really participating in the upswing. Crude oil, natural gas prices both went up a bit, but gold down a bit, silver down quite a bit. The SLV was down almost 5% today. Some of the soft commodities we've been highlighting, things like corn, soybeans, down a bit. You can see corn down over 2%. That's using the 2 Korean corn ETF. So the commodity space, I would say, not as constructive as what you're seeing with equities. So that's a bit of a different look. Cryptocurrency is pretty good. So you can see Bitcoin actually touched 82,000 earlier today, Eastern time. Currently, we're trading just above 81,200. So, still holding above that 80,000 level, which I would argue is pretty important. We kind of drifted below that. Getting above that big round number, I would say pretty meaningful. On the sector side, the whole idea of tech dominance came up a number of times in this evening's discussion at the CMT event. Sure enough, once again, the XLK up 1.5%. That's been literally the only sector to outperform the S&P over the last 6 weeks, come back to the end of March, continuing to dominate. Energy number 2, with crude oil prices popping higher, the XLE was up about 0.8%. Financials, third from the top, up 0.6%. That was one of the worst sectors yesterday. On the downside, materials and real estate, both down just over 0.5%. The healthcare sector and consumer discretionary, both flat. So even though this is kind of a risk-on day for stocks, note that consumer staples, sort of the defensive side of consumer, outperforming consumer discretionary, the offensive side of consumer. That ratio has been generally trending downwards for the last 6 to 8 weeks, we'll call it, and continuing to do so, even though the S&P and the NASDAQ are making new highs. Breadth decidedly less negative than what we've seen in recent history. You can see on the S&P, 60% of the S&P members closed higher today versus 40% decliners. You can see a lot of these are shaded in green, which is pretty encouraging. Even though small caps and mid caps lag behind, the breadth was actually slightly better. So in the small cap S&P 600 index, 66% of that index members were up versus 33% declining. So literally a 2-to-1 ratio, up versus down. Cisco, one of those names gapping higher. I did grab that chart just to show that one in a minute. Before we get to the charts, just a quick highlight that Broadcom did go higher, 5.5%. We've been talking about Broadcom with a bearish momentum divergence. Wrote an article for stockcharts.com earlier today, sort of addressing that particular issue. And, today Broadcom finishing up 5.5%. So not quite breaking out on stronger momentum, but getting closer with the day like today. NVIDIA also up as well, with the rest of the semiconductor space up over 4% today. On the downside, Amazon, Netflix, your two worst performers there. All right, as I continue my attempt to go quickly through the charts so that I can start resting up and getting ready for an early kickoff. I'm actually the first presenter tomorrow, I think at 8:30 a.m. Eastern. So I gotta get to bed here. I'm not doing a great job adjusting the Eastern time zone, unfortunately. So the proof will be tomorrow. Can I make it? I will report back, but I'm optimistic. I'm going to do it. Looking at the heat map here, and apologies for not being able to live stream tonight, but please, if you have questions as we go, please just drop them there on our YouTube channel in the comments section. Maybe we can feature one of your questions in our mailbag episode, which we are planning next, hopefully tomorrow. Here, looking at the major indexes through the heat map, I mean, boy, technology certainly the strongest in terms of the concentration of up days. Cisco, of course, the top performer in the S&P, gapping higher, but you can see some of the big semiconductor names doing quite well, as I mentioned. Micron, though, not doing well. I mean, we're fresh off of new all-time highs this week, down 3.4%. So an interesting kind of counter-trend move. SanDisk, which has been, I mean, one of the most aggressive gainers in 2026, pulling back quite a bit, finishing the day down 4.5%, closing back below 1,400. That's after powering above 1,500 earlier this month. Intel, Qualcomm, Akamai Technologies. There are a number of names here that, generally have had pretty good charts and are just pulling back quite a bit. So I think it's too early to, start raising some red flag of broad deterioration. But I'm certainly noting some of those names that have been doing quite well, not doing as well. And I tell you, with some of those names that had gone vertical and are starting to drop, charts like Oracle, some of the software names, we highlighted some of them here over the last week or two, just starting to break. I mean, just starting to rotate from a period of distribution to now a period of accumulation. Those are the charts that get me a little more excited than some of the hyper extended semiconductor names as we highlighted. Now, if you look outside of technology, this was not a particularly strong day, even though the breadth conditions were pretty good. If you look, there just weren't a lot of big upward movements, but just to quickly highlight some of the areas where I'm seeing strength. Financials, of course, have been one of the, has been a struggling sector at times, but you're seeing a nice move higher in charts like Apollo, APO, seeing a nice bounce today in Robinhood, up 5%, Coinbase. I mean, charts like Coinbase are right at that point where they start to look really interesting. I would say for Coinbase, kind of a good confirmed move above like 220, a close above 220 on stronger momentum would really indicate a new breakout phase, or sort of in a basing pattern going back to the beginning of March. It's not quite there, but it's kind of right up against that level. And I think that's an important one to watch. In the industrial sector, which I just moved around, sorry, they're at the bottom. I'm looking at the railroad names like CSX, rotated, bounced back higher. This is after chopping around the last week or two. So I like to see that rotating up toward a position of strength. Train Technologies, ticker TT, maybe putting in a higher low before rotating higher. Generac, GWW, there's a number of charts just making these nice uptrend moves that are continuing. Some of the logistics names like JB Hunt, back to a new all-time high today, up over 7%. So continuing to see some strength in some of those areas of the industrial sector, and I think that's an important space certainly to continue to watch. But railroads in particular, kind of back on the radar of strong charts. Finally, Philip Morris finally making a new all-time high, closing above 190 today. You can see some of the big box retailers also sort of breaking out. Looking at Walmart, looking at Costco. making a new 3-month high today. So that the 3-month high list filled with a number of consumer staples, and I think that's something to be looking at as well. I think that's it for the heat map. We're going to move on here in a minute and look at some charts that I've hand selected. Before we do so, do want to give a shout out to one of our partners, Seeking Alpha. If you go to marketmisbehavior.com/Seeking Alpha, you can learn more about their premium membership, things like the health check, where you take your portfolio or watch list to the doctor, as it were, and do a wellness check based on their quantitative methodology. I think it's a fantastic straightforward, simplistic version of a tool and technique we used to use in my Fidelity days. Often sit down with the portfolio manager, go through their holdings, focus on the things that really were no longer working, right? Things that they held that were starting to show signs of weakness. That's what this health check is designed to do. They also have some great research opportunities and access to their quantitative model and much more. You can find that at marketmisbehavior.com/Seeking Alpha. Use my link. You'll get 10% off a new account. I hope you will take a look. And thanks again, Seeking Alpha folks, for supporting Market Misbehavior. All right, I'm pretty good here with the timing. This is the most I've been able to push the time here. We'll see how quickly I can get through some charts. I'll go quickly. The S&P 500 continuing to move higher. We spent some time earlier tonight in the Fidelity chart room, and I've shared the story recently of, when the market was so strong that the price would literally go above the printed area of the chart, and we would have to reprint out the chart. The team would have to do that. And I always thought that was a really meaningful sign of a strong bull market phase, when we had to keep recalibrating the scale because we'd keep going off the top of the chart. And I eventually learned that wasn't the bearish signal. The bearish signal was when we no longer had to print out the new chart because we were no longer making new highs. It was a great lesson in trend following and the persistence of trends. The trend continues strong. Yesterday we closed up. Today a similar upward swing, again closing above 7,500 for the first time. RSI getting very, very close to 80. That's usually a pretty good sign for a trend, because when you get above 80, that means the momentum's so strong you're probably going to go even further. We used to call that the good overbought, when the RSI would get above 80. Hey, I've been harping on the increasing number of new lows. Great news. We actually did not make a ton of new lows today. As a matter of fact, new highs outnumbered new lows by about a 3-to-1 ratio on the S&P 500. So good to see those new 52-week lows kind of lightening up a bit. I still think this is something we want to watch for. There's a number of indicators like the Titanic syndrome, as we've highlighted recently, that are built on the market making new highs, but a lot of stocks making new lows. It's usually a really dangerous sign of lack of breadth support. Some of those, I think, warnings have been triggered here in the last week in terms of the concerning number of new lows. So great to see a bit of a change there. The VIX is continuing to tell us just move on, nothing to see here. The VIX is currently just above 17. We're sort of in the mid upper teens. That's a great place to be for a bull market. That means we're chopping around a bit, but the volatility is low enough that we can still consider this a low volatility uptrend. If you look back at a lot of the major bull markets in my career, going back to 2000, market making highs on the VIX sort of in the mid teens, upper teens is pretty good. I mean, that's a pretty consistent bull market range. What you want to be concerned about is if the market's still near highs, but all of a sudden the VIX starts to creep higher. That's what concerned us back in February. We're not seeing that yet. But that's something we'll continue to monitor. Hindenburg Omen has not fired yet by my count. However, I think it's worth noting we did check one of the boxes that we were unable to check. 2 of the 3 factors have now triggered using the stock charts version. There's a number of versions that are very similar, but just subtle differences. The stock charts version looks for the New York Composite Index, $NYA, on a number of platforms. That has to be higher than it was 50 days ago. Or put another way, the 50-day rate of change needs to be above 0. That actually hasn't been the case until today's close. We just finally went net positive. So that's check number 1. Skipping a beat, we can go to the McClellan oscillator, which is currently below 0. That's check number 2. Now what we would look for is on the same day, at least 2.5% of NYSE listings make a new 52-week high, and at least 2.5 make a new 52-week low. The problem with today's session was we didn't get enough of those new lows because, as I mentioned, there were just not that many of them. So the number of new lows has gone down quite a bit as a result. Hindenburg Omen not able to fire today. It was close yesterday because we had plenty of new highs and new lows, but the New York Composite Index was still negative for the last 50 days. So we're really, really close to potentially having another firing of the Hindenburg Omen. We had a cluster in October and November of last year. We had a cluster in February of this year. Do we get another round of the Hindenburg? We'll keep a look there. Sentiment data came out here. Thursday is the day we like to check sentiment. Bulls up to 39%, just slightly. I mean, that's about where it's been the last 3 weeks. Bears increasing up to almost 40%. We're at 39%. So bulls slightly edging out bears. I'm not seeing euphoric bullish levels. That would be a bullish reading above 50%. So at this point, that indicator is kind of right where you want it to be, I would say, if you're on the bullish side. NAAIM Exposure Index, kind of a head scratcher this week. Sorry for moving the chart all over. Last couple of weeks, we've been sort of in the mid 90% range. This is a weekly survey of money managers and asking them their allocation to the equity space. We're in the mid 90s right about now. That's where we've been the last 2 weeks. The last 3 weeks, that's where we've been. This week, down to 77%. So as the S&P is making a new all-time high, as the NASDAQ's making a new all-time high, money managers in this survey appearing to lighten up a bit on their equity exposure. That's a bit of a concern. All right, quick check on gold and silver. The chart of the GLD sort of in no man's land between the 50 and 200-day moving average, close to breaking above the 50-day, but not quite there. I think there'll be a strong bullish signal. We did get that bullish breakout back above the 50-day, back above the April swing high for silver. The SLV pulled back today quite a bit, around 5%. The $75 level on the SLV is that breakout point. We're kind of right back to that point. That's also a gap from last week. So I think holding 75 is pretty important. If we would break that, I'm looking back to the swing low from late April, just below 65. But for now, holding up. Here's the chart of Broadcom. We made a new all-time high today for the chart of Broadcom, up 5.5%. The momentum's still in a divergence situation. If we keep making new highs and the RSI pushes above 70, that would negate this bearish divergence and really signal further upside. I wrote an article earlier today on stockcharts.com digging into that divergence, and I would encourage you to check that out. Palantir, just a quick update on the chart of PLTR, holding support for now. Yesterday we talked about how it was getting back to the lower end of this consolidation phase, bouncing a bit higher today. That's a bullish harami pattern if you know your candle patterns. Cisco, big gap higher today, 13.4%. I mean, the news from Cisco is, hey, we're cutting a bunch of jobs, and hey, we're spending a ton on AI, and that spending on AI and spending less on people combo is a 1-2 punch of optimism for the stocks. The stock gapped higher. It was up as high as almost 120 earlier today. It did close below the open. So when we have a gap like this, I always like to look at the next day. Friday session is going to be vital, probably going into the next week as well. A gap and run where we gap higher and then continue higher, super bullish. A gap and fail where we gap higher and then drift lower, very negative. So I think what happens after that gap is what's most important. Finally, let's finish with a strong chart. Colgate-Palmolive. This is in the very boring, very unsexy consumer staple sector. But hey, as I sign off every episode, it's always a good time to own good charts. This qualifies to me as a pretty good chart. Why is that? Well, it's bounced off the 200-day moving average with this bullish momentum divergence. We now bounced above the 50-day. We're now resolving that to the upside. The RSI just slightly ticking above 60. So I would love to see a bit further momentum, but I think the break above the 50-day after the successful test of the 200-day, assuming stronger momentum, would be a really good sign. Folks, that was under 20 minutes. That shows you what I can do if I actually stay on task and don't think about what you guys are saying in the chat. We'll go back to the regular show when I can get back to Seattle and settle back in. But for now, I hope that this gives you a sense of what happened today in the markets using the best practices of technical analysis. Hope this gives you a more mindful way of making sense of this market, making new all-time highs. And I hope it gives you an idea or two along the way. Please take a moment, like the video, subscribe, do all those YouTube-y things that helps me keep market misbehavior successful. Please, if you have any questions that we could consider for our mailbag episode coming up soon, please use the comment section on our YouTube channel as well. I'm Dave Keller for Market Misbehavior, coming to you from Boston, reminding you, as always, it's always a good time to own good charts. Take care, folks.